Welcome to your ultimate guide to investments and strategies for 2025. Whether you're a seasoned investor or just starting out, this video will break down everything you need to know to make smart financial decisions. First, let's talk about why investing matters. Investing is more than just making money. It's about securing your financial future, achieving your dreams, and building long-term wealth. In today's economic climate, simply saving money isn't enough to keep up with inflation. Investing allows your money to work for you, potentially growing exponentially over time and helping you reach significant financial milestones, from buying a home to funding your retirement. Now, let's dive into stocks. When you buy a stock, you're essentially buying a small piece of ownership in a company. This ownership gives you a claim on the company's assets and earnings. Stocks are traded on exchanges like the New York Stock Exchange, or NASDAQ, and their prices fluctuate based on market demand, company performance, and broader economic conditions. They offer the potential for significant capital appreciation, making them a cornerstone of many investment portfolios. There are two main types of stocks: common and preferred. Common stock gives you voting rights in company decisions and the potential for higher returns through dividends and capital gains, but it also carries more risk. Preferred stock, on the other hand, usually doesn't come with voting rights, but offers fixed dividend payments and a higher claim on assets in case of liquidation, making it generally less volatile. Understanding these differences is crucial for aligning your investments with your risk tolerance and financial goals. Investing in stocks comes with both risks and rewards. The primary reward is the potential for significant capital appreciation, as company values can grow over time, leading to substantial gains. Many companies also pay dividends, providing a regular income stream. However, stocks are subject to market volatility. Their values can decline rapidly due to economic downturns, industry shifts, or company-specific issues, leading to potential losses. It's essential to research thoroughly and diversify your stock portfolio to mitigate these risks. Next up, let's explore bonds. Think of bonds as an IOU. When you buy a bond, you're essentially lending money to a government or a corporation. In return, the issuer promises to pay you back the principal amount at a specified maturity date and also pays you regular interest payments, often semi-annually. Bonds are generally considered less risky than stocks because they offer a more predictable income stream and a higher position in the capital structure if the issuer faces financial difficulties. Bonds come in various forms, each with its own characteristics. Treasury bonds are issued by the federal government and are considered among the safest investments. Corporate bonds are issued by companies and carry varying levels of risk depending on the company's financial health. Municipal bonds are issued by state and local governments, often offering tax-exempt interest income. Understanding these types helps you choose bonds that align with your financial goals and risk appetite. Understanding bond yields and duration is crucial for bond investors. Yield refers to the return you receive on your bond investment, typically expressed as an annual percentage. It can be current yield or yield to maturity. Duration, on the other hand, measures a bond's sensitivity to interest rate changes. A higher duration means a bond's price will be more volatile when interest rates move. Knowing these concepts helps you assess risk and potential returns in the bond market. Now let's talk about mutual funds and exchange-traded funds, or ETFs. These investment vehicles offer an easy way to achieve diversification, pooling money from many investors to buy a wide range of stocks, bonds, or other assets. They are managed by professionals, providing instant diversification and reducing the risk associated with investing in individual securities. This makes them ideal for investors who want broad market exposure without the need to research and select individual stocks or bonds. Mutual funds and ETFs operate differently. Mutual funds are bought and sold at their net asset value once a day, after the market closes. ETFs, however, trade like stocks on exchanges throughout the day, meaning their prices can fluctuate minute by minute. Both offer professional management and diversification, but the intraday trading flexibility of ETFs can be appealing to some investors. They both provide access to a diversified portfolio with a single investment. When choosing between mutual funds and ETFs, you'll often encounter the terms active and passive management. Actively managed funds involve a fund manager making decisions to buy and sell assets, aiming to outperform the market. This often comes with higher fees. Passively managed funds, like many ETFs and index funds, aim to replicate the performance of a specific market index, such as the S&P 500, and typically have lower fees. Your choice depends on your belief in active management's ability to beat the market and your preference for lower costs. Beyond traditional financial instruments, real estate offers a compelling investment option based on tangible assets. Investing in real estate means owning physical property, which can provide income through rent and appreciate in value over time. It's often seen as a hedge against inflation and can diversify a portfolio beyond stocks and bonds. Real estate can be a powerful wealth-building tool, offering both cash flow and long-term capital growth. Direct real estate investment involves purchasing physical properties, whether residential or commercial. Residential properties, like houses or apartments, can generate rental income and appreciate in value, but they require active management. Commercial properties, such as office buildings, retail spaces, or industrial warehouses, offer higher potential returns, but also typically involve larger investments and more complex management. Both offer direct control and tangible asset ownership, but come with responsibilities like maintenance and tenant management. For those who want real estate exposure without direct property management, real estate investment trusts, or REITs, are an excellent option. REITs are companies that own, operate, or finance income-producing real estate across a range of property types. They trade like stocks on major exchanges, providing liquidity and professional management. REITs allow you to invest in large-scale real estate portfolios, from shopping malls to apartment complexes, and are required to distribute a significant portion of their taxable income to shareholders as dividends, offering a steady income stream. Finally, let's touch upon alternative investments, with a focus on cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum represent a new and evolving asset class. They are decentralized digital currencies secured by cryptography. While they offer the potential for extremely high returns, they also come with significant risks, including extreme price volatility, regulatory uncertainty, and security concerns. These are not for the faint of heart, but for those with a high risk tolerance, they can be part of a diversified portfolio. Now that we've covered the different investment options, let's explore some key investing strategies that can help you navigate the markets in 2025 and beyond. These strategies are designed to help you make informed decisions, manage risk, and align your investments with your financial goals, whether you're looking for stability, growth, or a combination of both. One of the most effective strategies for reducing risk over time is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. When prices are high, your fixed amount buys fewer shares, and when prices are low, it buys more. Over time, this strategy averages out your purchase price, reducing the impact of volatility and helping you avoid the pitfalls of trying to time the market. It's a disciplined approach that builds wealth steadily. Value investing is a strategy pioneered by Benjamin Graham and popularized by Warren Buffett. It involves seeking out stocks that appear to be trading for less than their intrinsic or book value. Value investors conduct thorough research to identify companies with strong fundamentals that the market has overlooked or undervalued. The goal is to buy these bargain stocks and hold them until the market recognizes their true worth, leading to significant returns. In contrast to value investing, growth investing focuses on companies that are expected to grow at an above-average rate compared to the overall market. These companies often reinvest their earnings back into the business to fuel further expansion, rather than paying dividends. Growth investors are typically willing to pay a higher price for these stocks due to their strong future potential. While offering high reward potential, growth stocks can also be more volatile and sensitive to market sentiment. Building your investment portfolio is a journey, not a destination. It requires continuous learning, adaptation, and discipline. By understanding the different investment options and strategies we've discussed, you're well equipped to make informed decisions for 2025 and beyond. Remember to assess your risk tolerance, define your financial goals, and consider diversifying your portfolio across various asset classes. Start building your financial future today.